Well, welcome to another video, and today we're going to be looking at the weekly macro themes report, and specifically we're going to be looking at a previous edition where we talked through US commercial real estate prices. And really the key chart for this, and it pretty much it's almost one of those ones where it's just one chart. It's this one here, zooming in because it's that important. So the title of the chart really says it all. Inflation-adjusted US commercial property prices have moved well beyond the long-term average. And this is quite an interesting chart, really. It's quite an important one too. So first of all, what is it? So that blue line there, that's the US commercial property price index. So it's a broad index, and that's being deflated by core CPI. And the reason why I decided to use core CPI and not just headline CPI was because there's quite a lot of things going on in headline CPI, and core sort of gives you helps you get the signal, which is really what you're after, rather than some of the noise that you can get through in the headline. And so really the thing that stuck out to me was that you look at it from the 1950s through to present day. There's not really a trend as such. Like, I mean, maybe if you wanted to draw a trend line, if you can see the mouse cursor there, you could sort of draw it through there. But it really goes through a really long-term sort of range, long-term cycles, kind of thing, and there's some mean reverting tendency to it. And I guess really what sticks out the most on this chart is that it's risen back to those pre-crisis levels, and why it's done that is pretty clear. I mean, in the low yield environment, commercial property is one of those things that offers yield, and a lot of income sensitive investors, they have to go out the risk or duration curve to get that income, and this is probably one of the key examples of how they can do that. And that's really pushed prices up. The other thing too, even if we were to call it a bubble, we'll set that kind of debate aside for now. If you were to call it a bubble, any bubble really always tends to start with at least some sort of fundamental story. And the fundamental story for this is that US employment growth has been going pretty well. And I had a look at the breakdown of this, and so it's mostly the CBD prime office space that's really driving that, and obviously that's going to be benefiting a lot from employment growth. And as a side note, I guess too, the one that is underperforming or the worst performing part of the US commercial property market, no prizes for guessing, it's retail. And that's reflecting really that big structural trend away from brick and mortar to at least hybrid, if not pure internet kind of retail driven space. So it's interesting how these trends seem to work their way through. It's probably going to be quite some time before that trend of technology really disrupts the prime office space, and some might argue that it never will. But they still go through cycles, and at the moment, when you look at this kind of chart like this, and you see something that has historically range traded, historically mean reverted, and then it overshoots to the upside, moves very far away from the mean. If you were to draw a trend line, it would probably end up cutting through maybe around here. So even if you're looking at it against trend, it's still looking very much stretched to the upside versus trend. So this is probably one that I would add to the risk radar. It's kind of interesting. One of the other key risks that I've been talking about is China property, and at the moment China's property market is going very strong. Many ways reflecting this very strong market, and it could go on for a little bit longer. But the odds for performance versus the odds against performance are that ratio is slipping here. So whenever you get stretched beyond the average, the odds of further outperformance are low, and the odds of a correction or at least sideways movement increases. So US commercial property is definitely very, very high on the risk radar, and from a timing point of view, which is always important, it's one thing to identify a risk, one thing to talk about a risk, but I think the thing that a lot of commentators forget to do is talk about, the actual investment relevant timing. And so this one sort of helps with that, I guess. Commercial real estate lending standards have been declining, and typically history shows that when you get declining, when I say declining on this chart, that actually means tightening. So the lending standards have been tightening, and when you get that happen, that has in the past tended to, you've either seen a bit of a slowdown in prices or more volatile and lower returns, or in this case we actually saw a big crisis. And the reason that is because you think about the lending manager, they're either seeing the writing on the wall and deciding that now it's time to pull the horns in, and by the same token that can also tend to precipitate it, because if it's very much credit driven, liquidity driven, then as soon as you turn that tap off, you can tend to actually exacerbate what may be going on in the market. And then that light blue line is actually commercial real estate loan demand. So I've actually inverted that, so times it by -1, so they're on the same kind of basis as the red line, which is lending standards, and that means that it's actually contracting. So that is a definite ding 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 on the warning bells there. I would say that when you see these turning down like that, all that you need to happen now is for either a very big spike up in the cost of funds, which is not happening. I mean, it's happening at a very slow pace, or something else to happen with the fundamentals, like employment growth to roll over, or the economy to get worse, or to go bad. And we're not seeing any signs of that yet. So on that respect, you look at these two charts together, and you say that that's the risk levels are definitely rising, but until those economics roll over, it's not, from a timing point of view, that's the last piece of the puzzle that needs to really fall into place for this one to really, for the chickens to come home to roost, so to say, on this one. And I think I'll leave it there. I mean, there was another couple of charts that I did look at on this one. I guess they're worth kind of mentioning in passing, because, the prices look the same as pre-crisis, but, conditions aren't really the same. If you look at, we're much more advanced in the cycle on many fronts at that stage, the last cycle. Residential real estate investment is not anywhere near where it was pre-crisis. Non-resi is yet to really pick up as well. From a bank asset standpoint or credit outstanding, it's yet to. I mean, there was some deleveraging, decent pace of deleveraging, and a decent amount of deleveraging that it did occur. And it's still high, but it's not at the same kind of pre-crisis levels. So those would be the only caveats that I'd say. So you look at these two charts, you don't necessarily say that the world's going to end, but as a minimum, as I mentioned, with that red line, when that rolls over, when lending standards tighten, maybe you don't get a big crisis type of collapse, but you certainly get lower and more volatile returns. So that's even that by itself is a pretty important takeaway. And so I will leave it at that, and welcome any comments, questions, or counter reviews in the comments below. And make sure you subscribe to the channel, because I'll be doing these videos probably once a week. That's probably about all I have time for. So thanks for watching.